Hello, AIME member community. We have a very special guest today, as we all know, industry legend, President and CEO of MBS Highway. We got a lot to cover. Barry's ready to provide some insights into what's going on in the market, prepare everybody to communicate to their communities, their borrowers, and obviously the real estate partners. So everybody's staying ahead of the curve. So Barry, welcome. Thank you for taking the time to be with us today.
So great to be here, brother. I'm a little jealous of the tan, man. You're looking good.
I got a couple days out of the office this weekend. Went to Miami. It was nice. Wish you were there.
Oh, next time. So yeah, we are ready. There's a lot to talk about.
All right. So let's get started. Number one, the stock market's been going insane. It's been down 600, up 600. What is going on in the stock market right now?
So it's certainly a head scratcher. The market's just playing on momentum, and the Fed just adding incredible amounts of liquidity. Fed saying they're going to purchase corporate bonds is what got us turned around yesterday in the stock market from down big to up big. And then this talk about infrastructure. Now, this is something that happens every election cycle. You get lots of talk about infrastructure, whether it gets done or not. That's to be seen, but it would be good. We certainly do need that. That can be good for the economy as well. And then finally, this talk about steroidal use, dexamethasone. It's a commonly used steroid, which can help people that are very ill with COVID, because what happens is the virus dissipates, but then it's the body's immune response that can cause really deep problems, and this can mitigate that. So in cases where people were dying on ventilators, it cut the amount of deaths by a third, very, very significant. So some good things happening there. So reason for optimism, but the stock market's kind of just like taking anything it can now and running on the momentum. The thing of it is, when we look at some of the technicals and we look at past histories, this sometimes can be a bit of a vulnerable situation or a dangerous situation. As we saw just a few days ago, 1,800 point drop. It's an old story about the stock market is it does the most harm and the most damage to the most people at the worst possible time. So just proceed cautiously at these levels. Look, if the economy even comes back 90% of what it was, that oftentimes isn't enough for companies to stay in business, some companies to stay in business, because you need that last 10% there. And look, we all know, just look around, you can see that businesses are still not, for the most part, coming back the way they really need to. So once this kind of, to use the steroid term again, that the Fed is using on the economy and all these other programs, as that starts to slow and wear off just a bit, what's the economy really look like without this?
And that's a question I have for you. Is we listen to the Fed's commentary, and he expressed that they were planning on stimulating and providing stimulus to keep rates low through 2022. What are your thoughts on that?
So remember, that's the Fed funds rate, and certainly they're going to do that. Look, the Great Recession, they kept rates at zero bound for 7 years, so would not surprise me if it's beyond 2022. The thing is, though, is that mortgage rates don't necessarily correlate to the Fed funds rate. There's two different things. And the way to explain it to our customers, your customers are out there and they're saying, okay, hey, Fed's at zero for forever. That's kind of something that they might think that they have all the time in the world to move forward with. But the way I would propose it to the customer and go back to the customers and say something like, listen, if you were lending the money and you knew that you could offer a rate today, but you could change your mind tomorrow. So you could offer 2% today and then make it 5% tomorrow. Literally, that's what the Fed funds rate can do. But a mortgage rate, you commit to a rate, and that's good for, in many cases, 30 years. You're going to think twice about that. So the other factors you're going to look at is inflation. And inflation is an interesting one. We believe inflation will remain low, but what if we get a lot of demand and we can't get the reciprocating level of supply to come back up because of supply chain, because workers that are getting more money for staying home, that are afraid of contracting virus? If we can't get workers to come back, you could have a spike in prices, or companies saying, listen, we can't do capacity because we have to do social distancing. So the only way we can keep our doors open is to raise prices. That could potentially be inflationary, and bonds historically don't like inflation. I'm not saying this happens, but our customers shouldn't fall asleep at the wheel here. They need to know that things can happen while the Fed's at zero that could cause mortgage rates to be in a position that can cost them some money. I've seen you do talks about this too, Anthony. And, while we all think rates should remain low, I've heard you say it before. When you talk about, is this a good time to refinance? Well, certainly it is. If it makes sense for you, this is an incredible opportunity. Let's not get greedy. And here's something nobody thinks about. Let's just say the customer's right. They say, I want to wait because I think rates are going to go down a little further. Now, meanwhile, maybe they could save 1% on that loan, but they want to wait to get an extra eighth or an extra quarter. And what they don't realize is if it takes them 3 or 4 months to be right, it might now take them another 2 years beyond that, if they're correct, to get the benefit of that extra eighth of a percent to make up the difference of saving for the last 4 months or 3 months until they get there. So it's
that's great. That's a great. Honestly, this comes up, brokers. I don't know if you pay attention to this, because Barry just gave you the ultimate rebuttal for the customer and says, I want to wait for another quarter. Like, this is very, very timely. We get this request a lot, Barry. So thank you.
Yeah, and what if they're wrong? Look, I think rates are going to head lower. What if I'm wrong? Nobody's infallible, right? Don't miss the opportunity that you have right now. This is not a time to get super greedy. So what? So what? If you miss the all-time lowest rates by an eighth or a quarter, all-time in history, you did pretty darn well. Okay. So but you could miss it too. Look, we've seen moves in interest rates that have been pretty quick and pretty dramatic that have worked against us as well. I look at Japanese candlesticks, right? And there's this Japanese saying that maybe doesn't translate purposely, but it says, fear does not leave on a donkey, okay? Meaning that when there's fear in the markets, they're not strolling out the door. It's a massive run to the exits, and sometimes things can move faster than we can or our customers can react.
We saw that taper tantrum. That was a real thing, and I remember at that time, I had a pipeline full of unlocked loans because everybody was, rates were improving every day. Then all of a sudden, it was quick. How fast did we see the 10-year Treasury move and rates move during the taper tantrum?
Extremely quick. And the Fed was unable to just unwind their balance sheet from $4.5 trillion to $3.75 trillion. And that caused exactly what you said, that taper tantrum in the marketplace. So caused rates to go up. Remember, it wasn't that long ago that we were at the end of 2018, the beginning of 2019. Look, you're talking about a year and a half ago where we were looking at mortgage rates at 5%, 5 1/8. That seems like a very long time ago, but it really wasn't, really wasn't. So we've changed. We've come a long way in a short period of time. Again, I'm not saying that we get there, but things can change rapidly.
So over the last couple of weeks, we've seen some, early data releases come out relevant to, housing. We saw a surprise jobs report for May that kind of stunned the market. Today, we saw a really positive retail report. What do these early indicators tell you about, we went through this whole V-shaped recovery and all that good stuff, what the recovery is going to look like. Do any of these data points give you a better idea of what we're looking at?
So when you look at the numbers, the word I'd use here is relative. Relative is a very important term in this particular environment because the media gets it wrong. The media says, we were down 50% and now we're up 50% from that level. We're even. No, if you're down 50%, you have to be up 100% to be where you were. So the media doesn't really get math very well. So we have to. And when you take a look at what happened today with retail sales, we got a big spike, but that's from very low levels and very depressed levels. So it was really down in March, down again in April. Now we're just not even back to where we were, but it is a big move. Now the media says, biggest 1 month jump. Well, that's because we were never this bad before. So if you're on the floor, if you have no sales and you make, or if your sales drop to one sale and now you come in and you make two sales, you can say, hey, we're up 100%, but I can't survive on two sales. So this is what we have to understand is these are relative terms. The employment reports oftentimes get confused because, look, these numbers are bad, okay? The expectation for where we will see the number come out on Thursday is bad. In a normal environment, seeing it down 1.2 million job losses is horrible. But yet this is going to be celebrated. And while we are happy to see improvement, certainly, we have to remember that because you see less job losses, you look at the chart, right? And the chart goes like this. Then we have this big section that's now started to come down. It's still going to be up here. Even if it got back to where it was, what about this chunk of people that filed for unemployment? Where are they going to go? What's going to happen when the PPP money that businesses are enjoying starts to dissipate at the end of August, are those businesses going to stay in place? Are those people going to go back to work? And we still have about 25 million people. Don't go by the continuing claims number of 21 million because it doesn't count the last 2 weeks. You have to count those in. And you've got about 25 million people that are unemployed. We were at 5 million people. So there's an extra 20 million people without jobs. That's got to have an impact on the economy. Yes, the Fed's trying to do everything they can, but all of these numbers, that's why I use the word relative. It's better than where we were 2 months ago, thank God, but it's not where we were at the beginning of the year. And because of that, you look at things like you asked about the stock market. When we take a look at where we were in November on the stock market, is this the same economy that we were at in November? Well, according to the stock market, it is, but I think we all know better. And that's why I'm saying you have to just use some caution here. You just have to think about the bigger picture. It's great to make these momentum games. And if you want to be in the stock market, just be nimble. Just have some insurance plans in place. Make sure you've got some hedges in there, whether you're getting some puts, whether you're getting some play in the VIX, where you have some exposure to gold, just in case things go against you. It's not going to be a total washout.
With that said, what is the what is the indication right now on the Fed's buying all these bonds or mortgage-backed securities? Timeline wise, is that in TBD, or is there a timeline on when that'll start to be pulled back?
So you're right. So it is kind of TBD. They have not set aside any guidelines. It's just essentially as much as the market will handle right now. The Fed is out there, and this is essentially what is the Fed's kind of quasi yield curve control. So yield curve control is something that we saw in the 1940s when the Fed essentially put a target on the 10-year Treasury, and they said, we're not going to let it go above this level, or on the long bonds, so we're not going to let it go above this level. And anytime it does, we're just going to keep buying until it brings it back there. This is not specifically targeted, but it is similar to that. I mean, listen, every day the Fed's in there buying between $4 and $5 billion. Now, when you think about that, this is an enormous amount of money. It's $100 billion a month, $100 billion. After the Great Recession, we thought the numbers were unbelievable when they did QE at $40 billion a month. We thought that was unbelievable. There's $100 billion in mortgage bonds a month. I think that at some point in time, the Fed's balance sheet, which is clearly getting very large, and just earlier, Chairman Powell said that that is not a problem to see the Fed's balance sheet at these levels. I mean, what else are you going to say, obviously? But right. Can you imagine if you went out and said, well, it is a problem. We're doing it, but what the heck would happen then? So, it's kind of like, a parent with a child and there's something ugly going on and the kid's all scared. And the parent says, oh, don't worry, honey, everything's going to be okay. This is like Chairman Powell said, don't worry, everything's going to be okay. But meanwhile, I don't think it's so great that the Fed's out there causing these disruptions and getting into the corporate bond market. That is what happens to the companies that really do need to raise capital. What happens to normal price evaluations? These metrics that we've known are right now being thrown out the window. And when you take a look at forward price to earnings ratios on the stock market, getting back to the stock market, 22, 23, and we don't even know what earnings are going to be. That's optimistic. Every time in history, that has resulted in much weaker returns in the years ahead. So just think about this. Think about this. You're a baby boomer. You want to retire, or you're retired already. And now the Fed has already penalized the hell out of you. You don't have any place safe to put your money. So now you're forced to do nothing but put it in the stock market, right? Because they know that. They wanted to give you no alternative. Tina, there is no alternative. Except that we saw people lose their money and they got scared and they sold, so they got hammered there. Now, those who are still in the stock market expecting returns because the only place you can get a return, it becomes really difficult, if you look at history, to see significant returns in the stock market. They become quite compromised when you're at levels where price to earnings ratios are this high. When price to earnings ratios are at much lower levels, the next 10 years returns are almost always really good. Historically speaking, they have been always good. We don't know what the future holds, but when they're this high, they have been always much more compromised. So I can't get a return here. I can't get a return there. I can't get a return in the stock market. It makes it harder for retirees, which is why, let me talk to all of you out there right now. You guys are doing well. I'm hearing record months all over. What are you doing with your money? Are you putting it away? Okay, because you should be. Do not blow it here. Okay, you don't know how long this is going to last. I hope it lasts for a long time, but you should be making smart investments, and you should be putting your money away for the long haul. And there are things you should do. I mean, one of the calculators we have on our site that I love is a retirement calculator, because it's so easy. In like about 30 seconds, you could see where you are and what you need to do for your own future. But then you take that, internalize it, and you say, okay, I should be helping every one of my customers. So when I save them money on their loan, I could show you, Anthony, real quick if you'd like.
Yeah, please.
Kind of a real fun exercise for us. So let's do this. Let's share. Okay. So when we take a look here, I'm going to go to our site just really quickly and resort to the reading glasses. But one of the tools we have is the retirement calculator. So let's just say I'm in the mortgage business today and I'm doing real well. And I say, you know what? I want to have $100,000 a year income. And I'm going to do some very wishful thinking for me and say, I'm 39 years old. Yeah, that's a long time ago. But I want to retire when I'm 67 and I've got $80,000 saved. And I think I can get a 8.5% return before retirement and a 5% return after retirement, because I'm going to be a little more conservative. And I need to save $869 a month in order to achieve that. Now, some of you are looking at this and you're saying, geez, I could do that, no problem. Well, then do it. Okay, it's a great book called The Richest Man in Babylon. If you haven't read it, read it. I used to buy it in bulk from Amazon, about $4 a copy, give it to every one of my clients. All my 4 children had to read this book before they were 12 years old, because what it teaches you is pay yourself first. And if you can do this standing on your head because of the money you're making today, do it. If you want to play with the numbers and say, okay, what if I wanted $1 million a year income, $1 million a year? And you look at this number, this is what you'd have to put away. And some of you are looking at that, and based upon the money you're making right now, you're saying, you know what? I could probably put that away based upon the money I'm making now. Well, then do it and give yourself and treat yourself to $1 million a year income. Now, if you've understood the concept of this, what about if your client said, hey, I would like to have a $50,000 a year income, same ages. Let's say they've got $65,000 in the bank saved. Let's figure it out. It's $259 a month. How many of you are doing a loan for somebody and you could save them $250 a month? Now, what are they going to do with that? What are they going to do with $9 a day? What are they going to do? They're going to blow it. Okay. They're done. $9 a day. What are you going to buy? A sandwich? Maybe. Okay. So instead of doing that, why don't you show them and start to take the discussion away from rate and into, I am your advisor. I am helping you plan for your future. So let's take this $259, and instead of you blowing it because you already had a great rate, you don't need this money, let's help you and show you that if you put this away, talk to your financial advisor. I'll recommend one maybe, whatever it is, but start saving for your future. And let's turn a refinance, instead of blowing $9 a day, into a lifetime income of $50,000 a year when you retire. So these are the types of things, Anthony, that we want to make sure we look at. And a quick look at the markets with you. I mean, look at how kind of steady it has been for mortgage-backed securities. But I want us to be careful here. We are at a pretty important level. Look at how we tried to stay above the 50-day moving average. And for the most part, we're breaking underneath it a little bit here. So we just want to be cautious. When we look at the 10-year Treasury at 0.74, the 10-year Treasury has now just broken a little bit above this range. We've got a positive stochastic crossover here. So I just want us to be a little bit cautious going in here. Now, we've called this market pretty darn well. I want to show you where we've done our alerts in the past. And you can see here, I'm going to just kind of stretch it out to the end of last year. You can see these little markings are where we did our alerts. And you can see, obviously, they've been very well timed. But notice, we did not do an alert, Anthony, from December until March the 9th. We floated from December till March the 9th. I mean, we got all these gains. So what does this do for your business? I don't need pricing exceptions. I don't need to be doing false alarms. I don't need to lose a transaction because I locked and pricing got a lot better. I don't need to worry about a rate lock that expired and taxing my back office. And then you lock and you watch the market tank and you look like a hero and you close every one of your loans. So when you take a look at, look at along the tops here, that we did a rate lock alert here. This is the most recent one before this big loss that we had here. So this saved about 70 basis points right there. It's dwarfed next to some of these moves, but this is a pretty big move here. And this is the way you want to handle it. You know what's so funny, Anthony? I hear people all the time and they say things like, oh, I just get a loan and I lock it. Well, how did that serve you here? You pissed off every customer. You pissed off your company. You pissed off every wholesaler. You put yourself in a stressful position. How'd that serve you? Yeah, I locked every loan I did over here. Well, that sucked, okay? And your clients weren't happy. And plus, you're not an advisor. You're a robot. So you have to understand the marketplace. This right now, there's a lot of low-hanging fruit. So it's really easy to become robotic. But that's only going to last so long. This is the time to really shine, to step up your game, and to really be an advisor and understand these things and stop fooling yourself. Really put the time and effort in. Anthony, I have some slides just to go over with us. Do you want me to go over those real quick?
That would be awesome. Yeah, let's do it.
All right. So let's let me make sure you can see this. You can see this okay, bro?
Yep, looks great.
Okay. All right. So I'm going to try and go over some of these. I want to talk about housing real quick, and I'm going to go fast. So put your mental roller skates on. People are waiting longer to get married. They're waiting till like 29. And if you're 30 or something, 30 to 39, these are millennials. If you don't have kids, your home ownership rate's 38%. You have a kid, it's 80%. So the big driver is babies. And maybe because of COVID, maybe because people have been locked down together, people are getting busy doing something. Because what's happening here is we are seeing, according to Google Trends, what is trending is baby registry, the highest level in the history of it since 2004. Now, we know that's going to drive home ownership. Where are people moving? Out of urban. We all know that, but where are they moving? Exurb, exurb, exurb. If you don't know what an exurb is, you have urban, then the next outer ring is the suburbs, and the ring outside the suburbs, not quite rural, is exurbs. That is the hottest market. And who's driving it? The younger people. Under 35 is where all the action is. The home ownership rate under 25 is the highest of all. It is driving the home ownership rate. Total home ownership rate now is 65.1%, driven by those under 25, under 30, and under 35. That's where the action is, and they're the ones that move. These are the ones we got to teach our real estate agents about, because that's where they're going to get transactions. The older you get, the less you move. So you can do a loan for somebody over 50, and okay, once every 12 or 13 years, they're going to move. Okay, that's not bad. But what about here, where every 3 or 4 years they're going to move? There's a lot more transactions here, which means in your marketing, and Anthony, I've got to say, nobody does social media better than your team, and Nicole, who's like as good as it gets. And I love that she's out there teaching people in our industry the way she does, which is incredible. But you have to also include Instagram in your marketing. Yep. Because this is where people under 35 go. Look at these faces. These are all under 35 individuals, and you need to put stuff out there. Now, we know that inventory is tight, but it's going to get tighter. Why? Because look at builders. Builders got hit by COVID. They weren't keeping up with demand already, but look at what happened here. It's going to take them until 2022 just to get back onto trend, okay? That we are going to see less homes built because of COVID. And that means even tighter inventory. What does that do? It causes home prices to go up. We're already at the lowest inventory ever, and vacancies are very, very low. This is what's driving home prices higher. So if you want to see the fair value of housing, look at the price to rent ratio. Right now it's 17, which is very low. The price of a home is 17 times the annual rent. Let me do the math for you. $1,000 rent times 12 months, 12,000 a year times 17. So a home that's selling for 194,000 has got about $1,000 a month rent. In 2006, the peak was 24. We are at really good, attractive levels. Remember negative equity, 25% of homes negative equity? Well, 98% of homes positive equity now, 34% no debt, okay? Only 2% of homes negative equity right now. Housing overview, here we go. We went over this before, Anthony, but I think it's worth taking another look at it because it's such an opportunity. 124 million households, 43 million rented, 80 million owned, 27 million or 34% free and clear. Of the 53 million homes that have a mortgage, the average LTV is 53 and 177,000. The forecast for this year, look, it's been a great spurt, but a lot of that was pent up demand. I think it kind of slows down a little bit. I think that we see kind of flat growth in prices through the end of this year. But as good stuff comes out, as we are less fearful of dying from COVID, as it becomes more like a flu situation, or God willing, we get a vaccine, very good testing. There's some really good stuff on testing too. There's this Q Health, And we reported on this yesterday. Q Health, they've got this 25-minute test. You could do it every day, and then you'll attach it to your phone, and it's almost like a badge, almost like a pass, where you'll be able to show it and say, hey, I'm clean. You know, that's a good thing that we could see, so people start to feel more comfortable. As that starts to happen in 2021, housing is going to be really, really good, and you should be an expert in your market. This thing is so powerful to show. And by the way, realtors, do not forget them, because they are being forgotten, and real estate will be hot. If rates go up 0.5%, you know refinances will begin to slow, but purchases will be hot. The best way to backdoor it and get in with a realtor, you know, dogs, when they go out, they mark their territory, right? You need to mark your territory. How do you do that? You could do real estate report card, buy versus rent, drive traffic to your realtor's website by putting our little widget on a realtor's website. And then it's like a dog marking his or her territory. You know that you belong, that realtor belongs to you. That relationship is yours. Don't even bother. Because if you go to that realtor's website, my stuff's on there. My tools are on there. I'll give you a home market analysis in your marketplace. These are the types of things we need to be doing. And you need to show people the opportunity missing. There's no inventory, right? So every realtor gets pissed because they spend all this time, and now the customer says, I didn't find anything. I'll come back in 6 months or a year, if they ever come back. Realtors lost that time. Protect the realtor in their open house. Show them a cost of waiting. Say, yeah, if you wait 6 months, we know what the appreciation is in your specific zip code, what you'd lose on that. So you sure you want to wait 6 months? It's going to cost you $12,000 more. Or do you want to keep looking right now? I know it's tight, but this is the type of stuff we need to do. We talked about this earlier, Anthony. We know that Fed funds rate and mortgage rates are two different things. Look at the mortgage rates in red. Look at the Fed funds rate in blue. Look, Fed funds rate could go up, but that means sometimes mortgage rates go down. Goes way up, mortgage rates come down. Sometimes they trend in the same direction. But if you take a look, mortgage rates way down. Fed funds rate way down, mortgage rates up. Fed funds rate way down, mortgage rates up. They don't always go in lockstep. This was after the Great Recession. Fed kept them at zero for 7 years. No doubt in my mind, we're going to see zero from the Fed for a long time. But that does not mean mortgage rates during a time when the Fed's at zero can't go up. This was that taper tantrum. Rates were at, look at it here, 5% not too long ago. And this was, the Fed was at zero at these levels, and you saw rates going up here. And even with the Fed's rate going down, you didn't see that. It was almost a year ago to the day we gave our forecast that we were going into recession next year. Rates were going to go to zero on the 10-year Treasury. You know what? We hit that. And we did go into recession pre-COVID, before COVID. According to all the stats, we went into recession in February, pre-COVID. We believe that rates are going to stay very low. We think there's reason to believe that we might test some of the lows in interest rates. Look, nothing's a guarantee. I know, even though I called it on Fox when I said they're going to 0.5%, and they did. They wanted to debate me. Nothing is a guarantee. We have to be careful. But here's the thing. You have this unbelievable opportunity right now, folks. When you look at the amount of refinances we're doing today, in 2020, we're estimated to do 1.3 trillion in refis, 1.3 trillion, and we are having record months. Look what the opportunity is. Right now, there's 19 million transactions out there that qualify for at least an 80 LTV. Now, you could do a 90 LTV refi. Their mortgage is in good standing. They're current, 720 FICO or higher. You could do somebody with a 700, 690, 680. You could do their loan. They could save 0.75%. You could do a loan for somebody saving 0.5%. So with this strict requirements in place, there is 19.2 million homeowners, average loan size 4.8 trillion out there. We can't even handle 1.3 trillion. How are we going to do this, team? So get your marketing in place, get your team built. Anthony, I've heard you say this over and over again. Build your team for what's coming. You are dead accurate on this. And you need to make sure, team, that you are going to capture this opportunity. This is not the time to take it easy. This is the time to use this opportunity, put as much money away for yourself as you can, because you hit the jackpot. If you got on your hands and knees and says, oh, please, I hope for low rates. Well, guess what? You got the lowest rates in history. Oh, please give me a hot real estate market. You got as hot a real estate market as we ever seen. And you said, can I please have people have equity in their homes so they can be move-up buyers and I can do cash out refinances? Well, guess what? You got everything you've asked for. You hit the lottery. What are you going to do with it right now? What are you going to do? Are you going to take hitting the lottery and you're going to put that ticket in your pocket and maybe cash it in? Maybe it gets washed up in the laundry? Or are you going to go cash that sucker in? You can cash that in right now. You could do more business than ever before. And I don't want to hear pissing and moaning and bitching, oh, this product or that, or the rate's this, or the rate's that. Who cares? There is more business than you ever imagined. What are you pissing and moaning about? Just go make money and ring the cash register and help people. But make sure you do it right, because everybody else is doing it wrong. It's the easiest time in the world to be smart and crush your competition. Look, team, if somebody bought a home for $500 and they took out a loan of $400, and you can refinance them today and save them $230 a month on a 30-year, $700 on a 15-year. Everybody's going to say, okay, if the closing costs are $2,300, I know that you can't get that in Florida and New York. I got you, but we're just using an example. And you said, okay, how long does it take to break even? $2,300, $230. Somebody's going to say 10 months to break even. And everyone is wrong. They are all wrong. You have to be able to get this right, team. It takes about 7 months to break even. Even when you got your license, you were taught to do it wrong. Here's the textbook to get your license today. It says you take the amount and you take it and divide it by what it is. And it says, okay, in this particular case, how much it's going to take to recapture it. This is the wrong way to do it, because when you do it by payment is principal and interest. The only thing that's a cost is interest, not principal. So while the savings is $230, the interest savings is $264. The payment savings is $230. So it is a much shorter recoupment period. And hey, by the way, on a 15-year, how would you do it on a 15-year? It's $2,300 in closing costs, but I'm paying $700 more. How do I ever figure that out? Well, on a 15-year, what you do is you look at the interest savings again. And in this case, you're saving $500 a month. So it's about 4.5 months to break even on a 15-year. This is the type of math that your competition doesn't know. This is what you need to do. And just real quick, we've talked about this before. If you've got somebody, what happens when rates go up? Cash out refi, cash out refi, cash out refi. You should cash out refi every single person today and pay off their debts, because you'll change their life for the better. And you become immune to interest rate changes. I'm going to use a crazy example. Somebody wants to go from 3.5% to 5% with closing costs of $4,000 and no MI on their current loan. Who in their right mind would take somebody at 3.5% and go to 5%? Well, this might happen in the future sometimes, because you're refinancing everybody right now at 3.5%. What happens if and when rates go to 5% at some point? What are you going to do? So that's it. I'm not going to do any more loans on refinances. You have the unbelievable opportunity to cash out refi everybody. So you take their normal debts. They got 20,000 credit cards, a car loan. So what you do is you say, okay, yeah, it would cost them $250 a month more now, until I started using some of the equity that they've got in their home and started paying off some of their debts. And as I pay off all their debts, I could save them $1,200 a month. And with the remaining equity, you could tell with us where they are, what the hot item to do, renovate the bathroom. They want to do it, pull out the cash to do it. And now I'll save them $1,167 a month. But instead of putting it in that pocket and just blowing it, why don't we accelerate the payments on your mortgage and make a life-changing change for you? So instead of 27 years, you'll have 14 years left. I'll save you 147 payments. That is the best retirement plan in the world. In 5 years, if you hung up the phone, don't do anything, you're guaranteed, if you make your payments, amortize $45,000. You use my strategy, going from 3.5 to 5, but be doing it smart, you're going to amortize $116,000. I will guarantee make you, after tax, tax-free, $71,000. What do you have to make? $120,000 to do that? You're going to make an extra $120,000 in the next 5 years? In 10 years, it's $165,000. In 14 years, it's $300,000. Could you use an extra $300,000? And by the way, I only made your house better, your bathroom nicer. It's worth more money because we took out that cash out to fix it. And by the way, what if in this case, instead of going from 3.5 to 5, what if we saved you 0.75%? Well, now I'm going to save you $375,000. My landscaper, I saved him on this $26,000 a month. I said, go ahead and blow $10,000. Let's put $16,000 towards your mortgage. Guy's going to pay off his mortgage in 2 years. Team, these are the types of things you need to be doing. And I know you do a great job of teaching everybody, Anthony, but social media, do video. Yeah, Gary V at your thing last year, he was saying to people to do videos. Anthony, you do such a great job on all the videos that you do. If somebody says, man, Gary V could do that, Anthony could do that, I'm not as comfortable. We make it easy for you. We give you all the scripts of what you need. If the feds move or the jobs report, whatever it is, we give you a 45-second script and we turn your computer into a teleprompter. We make it so easy. You can change the speed, font size, and then one click and you post it. It's such an easy thing to do. Give yourself the presence that you need. So, Anthony, we got a lot of tools and a lot of highlights on here, stuff that just will ring the cash register. We did a survey of our members, and they said in the first quarter, people made on average $35,000 a month, $35,000 in that first quarter, 90 days more. That's $140,000 a year. So if people wanted to get on board on MBS Highway, you guys put together an amazing deal. Here it is, team. It's just mbshighway.com/P/BAB for brokers are better. Or you can email Jared at mbshighway.com, and he's got this deal. Don't go to our site and do it, because if you go to our site, this is what it costs you. But you've got an enormous discount through AIME that if you want to take advantage of, just hit this and you're good. So that's kind of like the fire hose method there, Anthony.
I gotta say, Barry, this is like the old James Brown, like coming off the stage, they put the cape on him, and he's like, "Please, please!" Like you just that was, guys. Like you watch this 3 to 4 times. If you can't sell after that, like just wrap it up and go work in a call center somewhere. Like that was value at the highest level.
Well, thanks, Anthony. But the thing of it is that, listen, if you are not so excited about what you're doing, you should wake up every morning. I do every morning and start the day with gratitude with my morning coffee every single day, because you know where we are. We are in this unbelievable position. First of all, we're having record months. And I'll tell you what, it's not that way for a lot of people. 96% of businesses are not in that situation. In fact, when you take a look at most businesses, they are down. 57% of businesses are seeing a decline that is rather significant in their business. We're in rarefied air. We should be so grateful, so excited, and maximize this opportunity. Look, you have been given a gift. You have been given a gift. Where the market is, everything's in your favor. This is your time. It's your time to seize it. This is your time to get out there and work as hard as you can, as smart as you can, and put the most into what you've got. Use the tools, use the way the market has set itself up for you to build your future for your family, for your children, for a long time of success. Do not look back at this at some point in time and say, I wish I would have, I should have. Don't do that. That will be so painful for you. Take this time and kill it right now.
That is that is key advice. The thing I would tell people is right now is not the time to be buying a new car. It's not the time to be buying a new house. It's not the time to be buying anything. All you should be doing is sitting at the cash register, like Barry said, and getting loans in, getting loans closed, hiring an LOA, hiring a processor, building your business, because when it's over, we saw in 2016 after the election, how quickly was that market over after the election, Barry? When we saw 10-year treasury rates went up 30 to 60 days, the game was over. So with this is as good as it's going to get, literally as good as it's going to get. It's a once-in-a-lifetime opportunity to create wealth for your family, to put money away. And when things slow down, then you go buy the car, then you go buy the house. But now's the time to focus on growing your personal wealth, closing deals, serving as many consumers as possible. The tools that Barry just showed you guys, like this is invaluable. If you're in a situation where you're competing against, like think about who our biggest competitors are, Quicken, Better.com, like these types of like call center people, they train these people to be, just giving a quote. This is helping you create and provide value that can change your customer's life, that can give them perspective that the guy in the call center is not going to give them. This is really, really important. So we'll share the link again for the MBS Highway discount that we have with through AIME. I think it's really, really important.
By the way, Anthony, you said one thing that just I wanted just to point out, Better.com. Anthony, remember I sent you that video link when the CEO was on CNBC. He took a major swing against brokers. He was like, don't go to a broker because they'll discriminate against your. How absurd. What an awful, nasty thing to say. So if that gives you any more fuel to go out there and really crush Better.com for what he said, then go out there and use the tools to make sure that his headset jockeys that he's got out there, that you're a lot better than they are, and you're going to create so much more value for your customers than they will.
That is, you sent that to me and I saw it, and it is what it is. What I would tell everybody is that when your competition's telling you that their objective is to put you out of business, to get you out of the industry, you got to compete harder. Like the value that's being provided today, that changes the equation of who's got the lowest rate. It's understanding the full picture and presenting the full picture to your customer, not being lazy and just giving them a quote. I think everything that Barry just went through is so critical to being an advisor. So Barry, some takeaways here. loan officers, brokers communicating to their real estate partners, talking about the second half of this year, rates, real estate market. Obviously, you talked about demand. Things are tightening. Builders are going to need some time just to catch up to trend because they've slowed down as a result of COVID. What does that mean to the housing market?
I think that the housing market is going to be extremely beneficial for those who purchase a home from the appreciation side. Because of the elevated rate of unemployment, I don't know if the pace of sales can continue after this pent-up demand surge. And let's remember that housing has to be looked at two different ways, and the media gets this wrong. There's housing, the economic driver of GDP, that's the number of transactions, which I think will be good, but because of lack of inventory, the media will get it wrong and say, oh, well, housing's slower, this and that. No, if you're a buyer of a home, appreciation will remain incredibly strong. So you will see a lot of appreciation, a lot of wealth creation, although the number of transactions after the surge that we're seeing might begin to soften and slow down. The media will misinterpret that. So it's up to us to teach our customers the difference between the two.
As far as just some upcoming things that we want to share here, obviously Barry's taking an hour out of his time here for us. If you don't follow MBS Highway on Facebook, do yourself a favor and do that. He's constantly putting out content that's invaluable. I've seen a lot of loan officers take what Barry does and leverage the content and create their own Facebook videos for their audience. So that's something to keep in mind. Obviously, Social Studio through MBS Highway is a tool that you guys can use. Couple just takeaways here as we wrap up. Number one, Infuse is coming up here. We have it scheduled for Infuse is going to be on September 26th. I don't know what Barry, you can keep him on the screen, Nicole. But Barry's going to be there. He's going to be presenting. Last year he was there, had a room. If anybody was there on the Friday of Infuse weekend, we didn't even have enough seats. Like literally there was 800 people packed in a room that could seat about 400 people. And it was standing room only. Barry, you killed it. You set the whole weekend up for just to be an unbelievable weekend. And Barry will be there again this year. We're really, really excited. But one thing I want to tell everybody, because of some capacity limitations, we're unfortunately, the Bellagio is telling us that we'll only be able to seat about 50% of what the normal capacity is. So we're down to just the last couple hundred tickets here. I strongly recommend registering as early as possible. I hope the Bellagio opens it up for us, but Barry will be there. We're going to have a great time. Other big thing for this week is every Wednesday is our weekly sales meeting. Barry's joining us. He joined us a couple weeks ago, or maybe it was last week, but he's going to be a regular guest coming on at least monthly and talking about a lot of the things we're talking about today, providing value to the community, making sure that we as salespeople are doing the best job educating our customers, our real estate partners, providing value, providing advice. So please make sure you put on your calendar every Wednesday at 11 a.m. Eastern time. Barry, we are grateful for everything you do for the entire industry, what you do for the community. I can't thank you enough.
Well, you know what? I'm very grateful to you, Anthony, everything you're doing, everything your team is doing. I want to give a shout out to my team. Everybody on our team is really, they're working at an exceptionally great level to bring this stuff out there. So, Megan, Dan, Diana, Matt, our team has really been giving it their all. And I especially want to thank the broker community. I'm one of you guys. I grew up as a broker in the industry. I feel that you guys are just, you're on the front lines, and I know what you're doing is not easy, but you're portraying the industry in such a great way. After the Great Recession, you almost would tell people like, what do you do? Well, I'm in the mortgage business. You're a little bit. Today, we should be so proud, and you all should be so proud of what you're doing. So I want to give you a heartfelt thank you for making all of us be really proud to be in this industry for all the good you're doing. So thank you.
Well, thank you, Barry. We appreciate you. We look forward to seeing you again. Everybody, MBS Highway, discount code is in the links, is in the thread below. Barry, have a great week. Thank you for all the value brought today.
Thank you, brother.
Have a great day.